days that have outside days down close in a market that's bearish by itself, it just means it's likely to continue lower. But if we are met with what we have here, we are at the end of the week. Thursday we had a mixed day. Didn't really continue going lower. Didn't make a new lower low. The three averages have not confirmed one another with the lower low on the daily chart. So if you take a look at your E-mini S&P June 2022 contract, and you'll notice the relationship between Thursday's low versus May 12th's low. It wasn't able to make that lower low compared to the 12th on May. Same thing with the NASDAQ, but we did get it lower on the Dow. So by itself, that's, I guess if you want to use it as like a Dow theory, the averages have not confirmed. And we're at the end of the week. We don't really have any news today. So it could potentially be a very lackluster trading session, going by face value, looking at what we have right now. But obviously, all that can change at 9:30 when the equities market opens up and things start getting moving around. So we'll see what we get in regards to that. But I wanted to kind of like roll back a little bit on the discussion with yesterday's whole entire day. The whole point was, and for those that have actually been with me for a while, you know this to be true. And even the folks out there that have my mentorship, whether it's been by hook or by crook, you know what I say in that mentorship. I talk about how on big down days or large range days, big ranges beget small ranges, and small ranges beget large ranges. I learned that from Larry Williams, and I think it's a truism. It's going to never fall out of style. It's real. When there's a lot of excitement, when there's interest in a market, that's when everybody else feels comfortable going in. And I don't want anybody to take one or two of those tweets that were given yesterday, which I obviously assaulted most of you. That's not my intention with the Twitter, but I made an attempt to walk you through a day, which I guess in retrospect, looking at how, I guess this is a lot easier, but I wasn't confident that I was going to make it work. So I had my son next to me, and I was going to just basically translate what I was giving him with you. So if I've given you a lot of tweets, or you're wondering like, man, what did I sign up? I'm not going to continuously do that, obviously, but the session yesterday was really geared towards how to avoid blowing your, focusing on the real manipulation and the move that takes place in the day, and how we moved and gyrated around that initial fair value gap. I gave you the levels and showed you in the video on YouTube last night in episode 32 of the 2022 mentorship series on my YouTube channel. It just kept going above and below and then gravitating right back to that fair value gap. Just stayed within that range. It only went up a little bit just to take the buy stops, and very, very shallow declines. And as soon as you determine, if you haven't really got that much experience in trading, the sooner you can find out that you're in a day like that, better. And then you're met with, do I continuously watch the market, or do I wait to the last hour of trading? And that's kind of like the takeaway from yesterday. You're going to learn by failure that you're not going to see these things coming all the time. But as a precursor, just know ahead of time, when we have big down days and there's a large range day and we're near the end of a daily range and we're within the last few trading sessions, and now for weeks and a month or so, we've been bearish. We've been seeing the indices go lower since the beginning of April or so. I'm not calling the bottom. I'm not trying to pick the bottom, but if you're going to be day trading or studying price intraday, you have to be aware of what may transpire after you see these big down days, especially if you see a outside day with a down close near the end of the price run. And what do I mean by the end of the price run? If you refer back to the low made on May 12th versus the April highs on your daily chart, that whole entire price swing we're near the end of it right now this week, but we didn't get a lower low on Thursday with NAS or SPOOs. We got it with Dow. So while I don't trade the Dow, and why don't I trade it? It's, to me, I think it's a little too sloppy. It's erratic, and I'd prefer to be in S&P. S&P will have the cleaner price moves. NASDAQ, if I'm in an idea that is parabolic, in other words, I think the market's really going to run, I think it's going to really take off and have a big range day, I want to try to trade in the NASDAQ because I want that, because it tends to exaggerate everything when it's a big move. Other people may say, well, I'm not going to trade the NASDAQ because it's going to rip my face off and I'll slow down and go into the S&P. I'm not like that. And you've seen me do that. I've done it with live trades, live account. I'm not afraid of that. You won't be afraid of it either, but it doesn't mean it's an invitation for you to go out there and risk live money. And everything I teach you should be viewed in the context of paper trading and demo. But I've kind of like wanted to go into this year, like I mentioned last year, of trying to prove to everyone that there's no reason for you not to go in and look at this stuff on your own and see it for yourself. But invariably, when you do these things, like Murphy's Law, whatever can go wrong will. And as a new student, it's very easily found for a new student to be discouraged because of initial adversities. And if you started, like, for instance, if say you signed up for this whole business of ICT mentorship, ICT concepts, smart money concepts, whatever, and you started learning yesterday, that is going to be a huge hurdle, and it's going to create a lot of doubt and confusion because the intraday range was choppy, it was sideways, and that was more or less what I was walking you through. Go back and look at the tweets and you'll see you can't just take one tweet out of there and say, oh, look, he did this, he did that, he didn't do this, he didn't do that. The whole context was stay out of the marketplace because we went to 50-50. So 50-50 means we're going to be in consolidation. Consolidation means wait till the last hour of trading. It doesn't mean you're going to get it right. It doesn't mean I'm going to get it right. It just means that as soon as you realize you're in a choppy range-bound market, especially with index futures, this is predominantly linked to just index trading. This is not a Forex idea. I don't like Forex, after noon, to be honest with you. Noon local time, New York. But if you noticed how we were just holding that range and ran up for the buy side, as I was outlining in the tweets yesterday, the whole context of what I was taking you through, a lot of traders just want me to, or students, I should say, want me to just get to the point, give me a way to buy or sell, pick my entry, give me a way to determine where my stop loss should be, tell me how to move my stop, when should I move my stop, and give me a target. And without expecting that to be understood, because I've already done all of that. Like, that's already on YouTube right now. The problem is there's so many variables to how the market's going to look, present. What I mean by present, it gives you opportunity, and sometimes it gives you these impressions that it may be a good day to trade, but then all of a sudden, as soon as you press the button, it does what it did yesterday, and it can be very frustrating. I can tell you, as a younger man in my 20s, when I first started trading the S&P, we didn't have these big ranges back then in the 90s. They were nowhere near the level of volatility that's available to all of us now. But the idea of getting in on those days like yesterday, when I was a young man, I would be in there trying to capture every continuation, bull flag, bear flag, the whole business. I would go after everything I possibly to anticipate the next run, but only on the upside because I was a buyer. I didn't want to short anything. But I would literally blow my accounts out all the time with those types of days. So you have to know what leads to those events, so that way you can avoid it, or at least know that once you're in it and you've taken a loss or two, you have to learn how to stop. Like, you have to stop and not do any more trading. And when it's easy and the markets are real primed, and we're not primed to do anything exciting yet. I'm watching the charts as I'm talking to you, so don't think I'm not paying attention to it. When it's easy to see the market drawing to a particular high or a particular low, and it's one-sided, that's what I teach as a low resistance liquidity run. Okay, where you have just a real easy run to an objective. It's so one-sided, you can't even argue about the possibility of an opposite perspective. That is my definition of high probability. I get the question all the time, like, what makes a trade high probability? The fact that you can only really define it either in a bullish stance or a bearish stance. And using the concepts that I teach, it is impossible to sell it to yourself as a opposing opportunity. In other words, if you're bullish, if you think the market's going to go up, can you go in any way, shape, or form, justify a short using what I'm teaching you? And if that's true, you can find something that's short. That's not high. It doesn't mean that it can't still go up. It just means that it's not high probability. So when I'm mentoring my students, I'm teaching them to look for those types of setups. And the whole point of yesterday was not a high probability setup. And I told you, watch, they're going to build this up, take the buy side out, and watch the middle of the range, and it's going to occur between 3 o'clock and 4 o'clock. I don't know why these beta males out there that want to sit here on the sidelines when it's safe and not show you anything that they're doing this year, but they want to talk and chit chat. Go into the whole timeline of yesterday and the real riders that were with me the entire day yesterday. Yes, it was grueling. Yes, I beat your Twitter up. Okay. But you came away with now a measure of experience that you otherwise not would have never had got without having gone through it. It's easy to get frustrated and say, you know what, I'm not anymore, I'm done. Or go in there and overtrade and not knowing what you're doing and then walk away with a toxic view about the experience. Whereas yesterday, all of us that were together, we were walking through the entire daily range on a 1-minute chart. So that way we are reading the intraday volatility, how the market would likely reach for a liquidity pool. If it doesn't reach down for it, what's it going to do? Change gears. If it pulls back into a imbalance after it's left it, I taught you how to save your stop. Don't wait for a full stop out. Like, there was a lot of things yesterday that if I were 20 years old again, I would have really had a notebook out and pen